Good afternoon. Thank you all for joining us for today's webinar where we'll discuss the Q2 numbers from the QwickAnalytics. My name's Sean O'Brien. Let's see if I can get my screen to move here. There we go. President of QuickRate. And as always, I'm pleased to be joined by David Ruffin. David heads up our IntelliCredit division, and David will handle the second part of today's presentation. Just a couple of reminders. As always, we will send out a link to today's recording, as well as a copy of the slides that we're using here today. As we've done the last couple of quarters, we'll have some polling questions that we'd appreciate you participating in. And then just a reminder, as we mentioned, David heads up our IntelliCredit team, where they handle external loan reviews, but we've also, we think, built a very nice application that we use in the loan reviews, but also that you can use in your own bank for internal and annual reviews, as well as a portfolio analyzer tool that we think you'll find very helpful. Most of you know as well, we do QwickAnalytics and QuickRate. Just, we'll kind of cover the same agenda as we normally do. I think, one of the focus today, certainly just on deposit costs and the implications going forward and kind of how dramatically they've moved here over the last 12 months. We'll go through the QCBI results. David will handle and talk about credit currently and just kind of the outlook, and then just share a few updates as we always do. Throughout, you can submit questions through the chat or the Q&A. I'll monitor those and we'll take them either through in the midst of the presentation or certainly at the end of the discussion today. As we mentioned, we've been doing some polling questions. I think we have 4 today. Certainly appreciate just to kind of get things started, see where everybody, is just kind of where they're at. We just thought we'd continue to do this. So I'm going to launch the first one. Again, just I think this may have been similar to what we did last month. What concerns you most over the next 12 months? On this one, we'll just do a single choice of deposit costs, loan demand, credit quality, or the valuation of your securities portfolio. So we'll just give this 30 seconds or so, and then we'll kind of keep moving on. Let me end this one, share the results. So you can see 76% of you indicated deposit costs, which certainly makes perfect sense. All right, so let me go back to the next question here. Regarding deposit outflows, are you still seeing deposit outflows at your institution? Just a simple yes or no. I know personally, the bank where I'm at, we've seen still some leakage, but certainly not at the pace of what we saw in the first quarter. So again, was as much curious from my own perspective, just to kind of see what everybody else is experiencing, here in the middle of the summer. So again, we'll just give this 30 seconds or so. Go ahead and end this one. 63% of you still are. 37% no. So that's for those of you who aren't, that's great to hear. All right, let's go to question number 3. Again, this may be a repeat from last quarter, but I'm always interested in just to see if things are changing. This just speaks to credit quality. Are you seeing any deterioration in credit quality at your institution? So again, we'll just go ahead and give this 30 seconds or so. Okay, this is great. Again, this is encouraging to see. About 85% of you who responded aren't, and 15% are. So again, that's for those of you who aren't seeing any yet, that's great. And then the final one is again kind of let's see, is that going to launch one? Is again around credit quality. Where if any, is the area of credit quality concerns? And here you can answer more than one if you want. But we'll C&I, consumer, CRE, or ag. give this just a few more seconds. Okay, we'll go ahead and end this one. This one's changed a little bit from last quarter, a little bit more broadly mixed, where the last time a lot of the focus was around CRE, so a little bit broader based concerns than last quarter. So again, we'll share these results with you in the email with the link in the follow-up, but again, appreciate you participating and in those polling questions. I think from a kind of current state of affairs type of thing, I think, these are all, I think, fairly straightforward, but, I think the challenge for all of us and kind of headed this up is just, the events of the first part of this year really, I think have seen, customers reconsider bank deposits, right? They see, or at least are equating alternatives in a way maybe they haven't, at least certainly in the recent past. But it's certainly put a lot of pressure on a lot of what we assumed previously to be some of our best depositors, and made us rethink not only our pricing around them, but just, I think ultimately the duration of some of these deposits that we've had. I think this has been particularly prevalent if you have a lot of high net worth customers. I mean, I think those, I think most banks would say have probably been the most apt to leave, right? They're aware of what other options are. They're probably inundated with requests and offers. So again, I think it's made us all kind of rethink our deposit franchises, in a way that we haven't had to in the past. I think from the outside world, regulators, but also investors who oftentimes are the drivers or the catalysts for changes in, FASB reporting or FASB, guidance. I think they're expanding, or talking about expanding focus, of mark to market, to not just all, to all assets, not just securities. So I think while nothing's, come down yet, I think we have to be, cognizant of the fact that there is a lot of discussion, going on around that. Certainly, because of the failures, Congress and then certainly any bank critics are calling for more bank-related legislation. I think most of us probably saw Chairman Grunberg, yesterday talk about, potentially, stricter enforcement of the Basel III, regulations, maybe new legislation or regulation around, it'd be more regulation, excuse me, around uninsured deposits and potentially, additional premiums around that. So I think, unfortunately, the events of this year are certainly going to, kind of crystallize themselves in probably in, additional regulation, or if nothing else, more enforced existing regulation. So again, that's a little bit of a headwind that we're all going to have to face with. And then, I mean, this is our business, right? But liquidity, interest rate, risk, and capital are just going to have increased focus and scrutiny from regulators and auditors. My thoughts, right, is, and while the numbers have not shown this to be a challenge yet, I do feel like we're going to our earnings will be challenged for the remainder of the year. Again, they're still really good here at the end of the second quarter, but I think it's probably with the rising deposit costs, we probably have to feel like and potential, maybe some credit issues, that our earnings will be challenged. There's just not a lot of, non-interest income, activity with mortgages. So it feels like they'll remain under pressure. The deposits certainly will remain under pressure. Rates are going to remain, they're going to converge and, just continue to be extremely competitive. And then, as I mentioned, I think regulators will reevaluate deposit duration, right? When all that money came in through COVID, I think we all struggled to figure out what the duration of that money would be. I think, we kind of had gotten to a point where we thought it was going to stick around a lot longer. And now we've quickly reverted back to really trying to understand, what the duration in these accounts actually will be. I think, some of the byproducts of that is that, the lower deposits and higher liquidity levels that might be placed upon us just has to mean probably, less lending, which again is impactful on earnings. Credit costs, while they've been nil for seemingly years, at some point you feel like in the next 12 months they might finally start to appear, and then we're just going to again see higher scrutiny on what we do from regulators. And I think that's important to know, right? I think as the numbers are going to show, we know as bankers what to do, right? And so I think the focus isn't going to be necessarily on what we know, but it's what we do, right? So I think in all areas, whether it's interest rate risk, whether it's liquidity management, whether it's loan reviews, stress tests, interest rate risk, you name it. We're going to continue to manage our banks in the effective way that you all have done it for years. But I think, we probably need to make sure we're taking and having a renewed commitment to ensuring that we're documenting what we're doing, what we're discussing, and what we're sharing with the board, right? I mean, I think to me, it's always, I've said this tongue in cheek for many years, right? If it's not in your minutes, it didn't happen from the eyes of a third party. So, don't diminish the good work you're doing by not making sure we're, accurately and, notating this in our minutes, because again, a lot of times what all these things really are refreshers. We know what to do. We just got to make sure we're actually, doing the blocking and tackling that we know how to do, and then documenting it. I think in terms of interest rates, right? We've all been playing the guessing game. What's the Fed going to do? I think we've reached the point where I think most, right? I think, you hate to do this, but I think we're probably closer to the end of rate, how high the rates are going to go. But I think the discussion's probably moving from how high to how long, right? So they could still very easily go higher here in the next couple of meetings. But it does start to feel like the conversation is shifting from, okay, we might be near the end of the rise in rates, but then the question becomes, how long are rates going to remain elevated? I think, again, a year ago, the expectation is we might have had a steep run up and then a run down, and now it feels like we're going to hang out here for a while. And so, I think that certainly has implications for us. We've shown this slide, I think probably for about a year now, but you can again see the number of banks who have, tangible common equity, less than zero. That number climbed, 0 to 1%, climbed. Everything else is kind of about the same, slightly higher, but this is a problem that's going to hang around. I feel like it. And if rates don't come down, are going to be with us. And then, not only does it have implications for these banks, but it has implications for all of us, right? Because, while we still may not have that severe of an underwater situation, those valuations just influence our behavior, right? They obviously threaten the solvency of their bank. They're going to, increase the scrutiny that we get. It ties our hands with liquidity because it doesn't allow us to sell those securities unless we can afford to take the losses. Again, we might not want to lend given that our liquidity is constrained. And then certainly it's really kind of stemmed up or backed up a lot of, if any, any acquisition activity that could take place. So for all those reasons, again, we started this by saying that earnings could be under pressure, but this in the environment we're in, these things are just the longer they hang around, just have a larger possibility or probability that they're going to affect more of us as we move forward into next year. Certainly QwickAnalytics has some tools to help. We do have a liquidity profile for any of those who have QwickAnalytics. You can monitor some of the ratios that your regulators might be monitoring. We'll calculate these for you on a quarterly basis. These do come from an OCC director's toolkit, but they'll give you a sense not only where you are, where you're trending, but how those compare with peers. We've added a new tool, which we will be doing a webinar on, I believe, next month on net interest margin, but just shows you the impact of the different components on a very granular basis of how it's affecting or impacting your NIM. but also again has the ability to show you from a period to period change, whether it's over a year or over a quarter. So this is something that we've been working on. We felt like now with where things were, it was an appropriate time to introduce it. So look on your tab, you'll see it's kind of covered up from my screenshot, but this right here is the net interest margin. There's a couple of tabs you can click on, but look for a future webinar where we'll really kind of talk through this in greater detail. So let's move to the QCBI numbers. Again, we're under 4,700 banks as we sit here at the end of June of 2023. The breakdown's pretty much the same as we've kind of seen it. But I think here's where things start to change, right? I mean, 2020, 2021, we had huge, obviously, influx, huge asset growth. Here, today, over the last 12 months, 40% of the banks in the country saw no asset growth. The median value was about 2%, but you can see here 40% of the community banks in the country saw no asset growth. You can see it down by asset size. Not surprisingly, the 0 to 100 were the most challenged, but even the 100 to 250 million, barely saw any asset growth. Loan growth, has stayed surprisingly strong. 53% of the community banks saw 10% plus loan growth over the last 12 months. But you can see down here all the different size buckets, asset size buckets, saw loan growth over the last 12 months. Deposit growth. Now here's where things have really changed, right? A couple of years ago, huge insurge of deposits from the COVID related PPP dollars. But here now we've got 56% of the banks in the country who over the last 12 months have not seen any deposit growth. And down here, you can actually see this in more granularity. Not only has there been no growth, but we've seen contraction in 3 of the buckets, essentially for banks under 500 million, just a slight improvement for banks between 500 and a billion, excuse me. So again, this is a problem that I suspect we're going to grapple with here through the remainder of 2023. But, as I said, you do a great job managing your banks. And despite all that, you have been able to pass along your pricing on loans. So you see a nice uptick in the median yield on loans, 71 basis point increase. Unfortunately, though, the corresponding rise in cost of funds at 92 basis points at the median, has still led to an improved NIM, but certainly, again, kind of foretells, continuing pressures, on our deposit franchises. Non-interest income has stayed relatively the same and a slight uptick in the efficiency ratio. So again, really, really well done by all of you. I had a chat come in that they were seeing a different slide. David, do you see my performance trends slide?
I do, Sean. Yes. Mm-hmm.
Yeah, thank you. Lisa, I apologize. I'm not, maybe there's a delay in our feed, but I apologize. Profitability, again, pre-tax ROA has remained strong for everybody. Almost, every asset bucket, is right about 1% pre-tax ROA. Core operating earnings, again, held pretty strong. And then again, it kind of through the asset size. Okay, so, all right. Median ROA, 91 basis points. So again, a small drop, but still, again, really given everything that's happened, I think it's pretty impressive. Median return on average equity, still above 10%. Certainly if you look to the right, the larger banks are able to absorb those better than the 0 to 100 million. But again, I think speaks to the job that you're all doing. Again, in light of everything, you're executing and still delivering, not only strong returns to the bank, but to your shareholders as well. So at this point, I'm going to turn the presentation over to David, and he will take us through the second half of today's discussion. David, the screen is yours.
Okay, hopefully you can see. Oh,
Uh,
there we go.
There we go. I got you. I see your
Oh,
screen.
all right. Well, thank you. As always, I thoroughly enjoyed joining with Sean on these quarterly visits with the broad group that attend. What I'm going to start with are some national and regional metrics that come from obviously our sister division, QwickAnalytics. And we at IntelliCredit, frankly, are focused, as you know, these are public call report data. IntelliCredit in many ways focuses largely on the non-public or idiosyncratic numbers that really percolate up through your loan portfolio, which those of us that are arguably credit risk people tend to understand that that's really the art of credit risk management, is where you begin to see emerging credit risk emerge. So what we're starting here with, again, we basically divided the country into 5 regions generally with states. These, again, are under $10 billion in assets. The national numbers are in the blue line. The NPLs to loans, which is the non-performing loans, the only issue there seems to be a little bit of an uptick in the Northeast in terms of their, at least relatively speaking, on a comparative basis. But again, the trend has been since the pandemic to significantly, given I think all the government assistance that came in, obviously that probably had an effect, but also it has kind of leveled off in terms of no indication, as Sean indicated, the public call report metrics are showing virtually no deterioration of credit. Now, charge-offs are just inconsequential at this point. The reserves to loans, one of the potential items of interest here is that, remember, the Northeast banks had a little bit of an uptick or a little higher level of NPLs, but they actually have a lower amount of reserves, which I think, just generally speaking, is going to probably engender some conversation perhaps from a regulator. The inverse of that I like to look at is how much percentage of your existing inventory of problems, which are very sparse throughout the entire industry, are being covered by your reserves. Again, this is not a capital cushion issue. It's just strictly what's in the reserves. Again, the same general point here is the Northeast banks seem to be a little bit of the laggard in terms of reserves around the other regions of the country. In what we traditionally look at in terms of real estate concentrations, we have to the right, which is the broader 300% guidance. Not surprisingly, you've got the north, well, the west, I should say, and the Northeast are actually leading the other regions. The Midwest states are a good bit behind on the broader 300% guidance. There are 328 banks in the country that exceed that. Remember, this is guidance, not regulation. On the subset of that, which is construction development, somewhat predictably, the Southeast and the West, or the Southwest, I should say, and the Southeast are leading in exposure or concentrations of that. That particular metric tends to follow demographic and economic growth. As far as other concentrations are concerned, let me start with the middle, which is the C&I loans. Again, the big blip up there is the PPP program of a couple of years ago. It's kind of returned to more normalized, really across the regions. The ag, not surprisingly, again, these are commercial banking numbers. They're not Farm Credit System numbers. The Midwest significantly leads the other regions. I would go back to the chart on the left, however, which is multifamily, because I really think this is interesting that this is continuing to tick up across, for the most part, all the regions. It just has been my experience over the many years that multifamily plays kind of a seesaw component with 1 to 4 family residential mortgages. And as you know, with the mortgage rates continuing to tick up, and you've got situations where a lot of younger buyers have been pushed out of the home ownership markets, they are immediately, going into multifamily apartments. So, but again, that is, over the history of my exposure to banking, has been also a bubble that we have to be aware of or watch out for. So let's talk about current credit conditions. Again, the credit performance metrics are still good, But I think, as Sean has already well documented, they're being somewhat clouded by several factors. Liquidity and deposit run clearly have been the primary front burner concerns of banking, not credit quality, the bulk of this year. Reserves, as you saw, are beginning to level out. They were ticking back up for a few quarters. Loan demand is moderating, although it's still been relatively strong, as Sean did indicate. But that does lead some of your borrowing customers to a genuine fear of a credit crunch. I was speaking and teaching at the Florida School of Banking just last week, and several lenders said the crunch is already here. As you know, larger banks sometimes can be more arbitrary in terms of cutting the spigot off. And particularly in the CRE world, we're seeing some indication that some of those spigots are being cut off, and really without any correlation to the quality of it's really more of an exposure or a concentration issue. Credit servicing, which we see in our extensive loan review work and the few M&A deals we're involved in, we still see that struggling. That's post-booking. How do you analyze? How do you obtain current financial information? A lot of that's a carryover from the pandemic and so forth. Vintages of all this loan growth, again, I said this many times on a quarterly basis to the audience here. Remember the proven empirical connection to a lot of robust loan growth just before a change in a credit cycle often becomes the most problematic. So I would certainly urge all banks to be monitoring the performance of their more recent loan growth. Rising consumer debt and delinquencies are now real. That's not speculative. It is showing up. I think certainly for commercial banking, it doesn't have anywhere near the exposure that the credit unions do in consumer purpose lending. But the incredible amount of added debt, which I kind of call the more susceptible consumer, is taking on record number of exposures in credit card debt and so forth. These tend to be people that are living paycheck to paycheck. As I think I said last quarter, I differentiate the consumer between those that have the connection to 401ks and a little healthier balance sheets than the paycheck to paycheck consumer. I do think Sean has certainly well pointed this out a couple of times in the webinar today, and that is be prepared. It's human nature. We've had a decade virtually of benign credit performance. The slightest uptick, unfortunately, in credit stress, in my opinion, is going to bring some overreaction by both the investor and the regulatory community. But I think what I'd like to kind of close with is really something that is, I think, a significant issue that we those of us that are connected to the community and smaller regional bank industry need to be concerned about. And I think that for commercial bankers, most concerns clearly is centering around CRE loans. This is rather sobering data, actually. I saw this about 3 weeks ago. And basically what it's saying, if you look at mainly to the chart to the right, if you look at the 2015 to 2019 averages, which obviously is all pre-pandemic, in effect, this is looking at every entity that is financing real estate across the U.S. economy. That starts with CMBS, investor-driven, private equity, government agencies, and so forth, insurance companies. And when it says national banks, we're not talking about OCC banks, we're talking about mega banks, what layman would call a mega bank, and then the regionals and communities. But look where we are at the end of 2022, a significant increase in CRE exposure at the smaller banks. And I do think that is a major concern. As you can see, this other chart shows you that for banks in the billion to 10 billion, which is the great bulk of our CMBS, our QCBI data that we do report to you on this webinar, is in effect, about a third of your bank assets are tied to commercial real estate. If you look all the way over to the mega banks, 250 billion or more, those are just not, they're under 6% of their assets. So the general exposure to commercial real estate, I think, is of some concern. There are some signs. I granted a couple of points I'd like to make are in areas that aren't relevant necessarily to community and regional banks, such as CMBS, commercial bank, mortgage securities, and the also REITs, real estate investment trust. I presented to Illinois bankers about 2 weeks ago, along with an expert on REITs, and his rather astute presentation said, REITs are still earning quite well, and that hasn't shown any deterioration yet. But what he did warn, he said the trading on REITs is almost approached record discounts. Point being is there is a considerable sense, at least in Wall Street perspective, that there's a bit of trouble on the horizon. There's increased delinquencies at CMBS. We know the paradigm shifts of office buildings, some of the challenges to retail, traditional commercial real estate, but also, and this is pertinent to, again, what Sean has been talking about, Morgan Stanley now estimates $1.4 trillion of office space alone will be up for repricing in the next 24 months. All of this did not escape the attention of the regulators. The 3 federal banking regulators joined the NCUA, which is this credit union regulator, on June 29th, and issued effectively a directive to kind of warn the banking industry, financial industry, of concern by the regulators around this. Now, arguably, part of this was a bit of an olive branch by the regulators, saying overtly that they are also admonishing their examiners to not go in and willy-nilly criticize financial institutions, or in a knee-jerk way classifies to not, to criticize or classified loans that just happen to lose market value below the principal. Now, again, as Sean alluded to, this is going to require, that sounds all well and good, but what the undercurrent of all that guidance was that it still has to be documented and in some way tied to your risk profile and your policies and procedures. So I think if you get engaged in any type of short-term or long-term workout on CRE loans, you can't be left in a verbal defense of your strategy. You're going to have to document that and tie it, connect the dots, if you will, to policies and procedures. And my hunch is, and a lot of that's, we're going to have to dust off, because we haven't needed workout specialists. We haven't needed some of this expertise for years. So there will be probably some attention needing to be directed to spiffing up policies and procedures. This, at the risk of sounding insulting, for those of you in the credit world, I still come back to this very simple metric. This totally dominates CRE risk to me, always has been, and that is where you are and where your bank is on the supply and demand curve relative to whatever property or project you're being asked to finance. And obviously, the optimal lending territory tends to be where there's more demand and less supply. When it ever crosses that line, that's where banks tend to get into more difficulty. Now, I'm just taking this as a snapshot. A good source of good kind of market or momentum CRE comes from the Atlanta Fed. It's all free. It's not a question of paying a subscription service. But I happen to just take, these are either regions of states all over the country. As you'll see down at the very bottom left is the United States average. Now, this is a so-called momentum index of hospitality loan types or projects. The blue line, the blue part of the bell curve is largely downward trending momentum. The warmer or oranger colors are upward trending. This is not to be in any way misconstrued to imply embedded risk. It's just strictly where activities are taking place. And I do think if you go for, if we had the time to go through this product by product, I've done this in several states lately, is the remarkable differences that occur between hospitality or office space or retail or industrial. They all have different profiles. And even within certain states, you'll see they'll be all over the lot in terms of where the so-called momentum might be. So I do think that one of the things that in conclusion, and you've heard me say this many times before, if you've been on these quarterly webinars, IntelliCredit is really dedicated to take three primary inputs to management that involve credit risk, such as stress testing, portfolio analytics, and loan review, and push them a little closer together. They tend to they've always been kind of self and different disciplines altogether, make them much more in cohesion with each other and in sync with each other. And I think that this is going to be a dedication that all bankers are going to need to make in the next 2 or 3 years, because of everything Sean and I've been saying about the potential for some overreaction. Because in the end of the day, what you're going to probably be burdened with is writing your own credit quality script, understanding your risk profiles, defending yourself, if you will, on what might be a more aggressive or even a hostile regulator, either misconstruing where they think your risk may be. Again, the burden now is no longer passive. It is what it is. I think you're going to have to do some prep work to explain whatever risk profile you have in place at your bank. So again, that's a lot of what philosophically IntelliCredit has been designed to do. And I will always enjoy being with you quarterly. And at this point, I'll hand it back over to Sean.
All right. Thanks, David. Let me grab the screen back here. So as David mentioned, right, again, I think it's one of the reasons we're excited to have David and his team join us. We felt like, we were moving to an area where we're all impacted by technology. You've heard me say many times, right? I think for community banks, we'd all like revolutionary technology. Oftentimes we really need evolutionary technology. I think what we've done at IntelliCredit is try to, again, recognize where, I know personally, like where our bank is, and just, try to develop tools that could make our team more efficient, give us better at the board level, better visibility, our management team better visibility, in the easiest transitionable way possible. And so, starting with the loan review service, everything's kind of built on the flat file. And then once we have that file, we have a number of tools that you can, take advantage of the data you've already put in there, and then continually populate it and just give you additional information. So I'll stop there on that, but just if you're ever interested in learning a little bit more about IntelliCredit, certainly reach out to us. We'd love to give you a quick demo. QwickAnalytics, I think everybody's aware, but I do think within the interactive bank pages, probably a time to refresh yourself with, again, whether it's the liquidity profile, whether it's the net interest margins tab, just take a look at some of the tools, the credit stress test. Again, all included in your subscription, all very timely right now. The credit stress test, obviously at the portfolio level, is a great first step. It kind of captures your capital cushion. But again, I think all tools that are can be helpful and just be, maybe save you money from having to hire a consultant to do it, but something that you can, very quickly get yourself up to speed with and then run on a quarterly basis as you deem necessary. Again, just, IntelliCredit's our newest division, but, I think we're proud of you certainly are proud of the growth that David and his team have, kind of displayed. We've got, 70 active clients in 28 states. So we're doing, reviews all across the country. So don't feel like you'd be talking to somebody whose background is very regionally focused. We're doing reviews all over the country. Again, I think with the tools that we've built, have made that process not only more efficient, but more meaningful for our bank clients. As I mentioned, we do the third-party review, but then the application has 3 components: 1, portfolio analyzer; 2, the smart loan review, which you can use the same tools that we use in the external review, you can use in your own bank for your internal reviews. Or if you're only doing annual reviews, we've got an application that is part of the analyzer that you can utilize the data already in the flat file to again, try to accelerate and streamline and better manage that process. So, just better ways to service your portfolios. Upcoming, again, as I mentioned, August 30th, I knew it was right at either this month or next, but we do have a QwickAnalytics, we call it a tour, but myself and Steve Huntington will take you through our new NIM tool. So we're calling it Deconstructing NIM and More. So that'll take place on August 30th. So certainly register to attend. Even if you can't attend, if you register, we'll always send a copy out of the presentation along with the slides. So certainly, consider registering for that. If you missed our webinar about IntelliCredit, again, you've heard me say enough today how much I'm excited about it, but we did a webinar this month with Zane Smith, one of our clients from American Bank. We let Zane kind of tell you how he's using it as a chief credit officer and chief risk officer at his bank and how it's helped him. We felt like it was a better way for a banker, a chief credit officer, to illustrate how the tool is helping him. And we felt like Zane's experience, not only as a chief credit officer and risk officer, but his background as an examiner, just really made for what I thought was a really compelling webinar. So that's recorded. You can certainly go out and watch that webinar on the IntelliCredit website. Of this, I guess not this Friday, but next Friday we'll have our monthly coffee talk. So for any of our CECL customers, or frankly anyone, you can register for that one as well. So, again, I know everybody's time is challenged. We just know we're trying to be available and as helpful as we possibly can to make anything you're doing with us a little bit easier. So Steve Huntington and I again will be on the Zoom call August 25th for our coffee talk. All right, so if you have any questions, I apologize to we had a few folks who had difficulty either with the timing of their screens today or we're having problems just viewing the webinar. So certainly look for the email that will contain a link to today's presentation and a copy of the slides. Certainly reach back out if you have any questions. You can certainly submit any questions now. If you'd like, the chat and the QA is the easiest way to do that. We'll give that in just a minute, but if not, David, any closing words or thoughts for everyone today before we let them back to their day?
No, I just think, again, we've tried to blend very seasoned reviewers with up-to-date technology, and we think that's the best of both worlds, applying for review work. And so, please give me a call personally if you would like to get in line with the RFP for loan review for next year, or further let us show you a demo of what we're talking about in terms of what IntelliCredit entails.
Great. Well, thank you, David. Thanks again to all of you who took time out of your day to join us. We really appreciate it as always. We'll look forward to hopefully seeing you on a future and upcoming webinar. And then David and I will be back. I guess it'll be November with the third quarter numbers. So we hope you'll join us again. But in the meantime, all the best to you. Be safe, be well, and we'll talk to you soon. Bye now.